Hey, it's Tom here and welcome back to the channel. So in this video, I want to talk about the topic of debt. I think in the stock market community, debt really does not get as much attention as it probably deserves. When you jump across to the real estate community, they talk about it openly all the time. And I think it probably deserves potentially even more attention on the stock market investing side because debt can sometimes be quite complicated, but nobody seems to talk about it. And anytime that people do bring up the topic of debt with stock market investments, you'll often hear very generic rules thrown out there. People will say things like, just don't invest in a company that has any debt at all. They'll say things like, never invest in a company that has more than, say, 3 years worth of earnings in long-term debt. And I really don't think that gets you kind of a nuanced understanding of the whole topic. So consider this like a debt basics video when it comes to stock market investments. I'll walk through basically where to find information on debt as it relates to a particular company. And I'll also talk through some of the pros and cons of a business having debt and some of the key things that I tend to focus on as a stock market investor. So if you like the video, hit like on the video and subscribe to the channel if you haven't done so already. But for now, let's get straight into it and I hope you enjoy. Now, firstly, let's go back to the real basics when it comes to debt, because debt is kind of a double-edged sword. If used intelligently and used well, it can really enhance your return on equity and your returns as an investor in a particular business. And if it's used unintelligently or, companies take on too much debt than they really need to or can, tolerate, then it can potentially put your stock market investments at a lot of risk. And debt is definitely the number one culprit for businesses going to zero. They take on too much debt, they can't meet their obligations in terms of paying back that debt, and that can wipe you out as a shareholder in those businesses. So it really is a very important one to understand. And most of the time people are using debt in their companies in the first place is basically to grow the equity in their business faster than they would be able to otherwise. Just like you might go and buy a real estate investment personally. If you go and buy $1 million property, you maybe put down a 20% deposit, so you put down $200,000 and you borrow $800,000 from the bank. The return on equity that you're going to get in that investment is enhanced by having that debt. So if you had paid all cash for that $1 million property and the property value doubles from 1 million to 2 million, you've doubled your money. So your return on equity is 100%, I guess, in that investment. Now, in the situation where you have debt on that property, you put down 200,000, you borrow 800,000, and then the property value goes from 1 million to 2 million again, you've much more than doubled your money because you only put $200,000 down, but you've captured $1 million gain on that $200,000. So suddenly you've turned your 200 grand into 1.2 million. So that really is the attraction to debt for a lot of people. It can be dangerous, certainly if you, take out too much leverage and you can't meet your debt obligations, but it can be a really powerful tool if used intelligently. So really the number one thing to understand when you're looking at a public company that has debt is to try and understand how much debt it has in the first place and what those debt obligations actually are. So in the 10K, in the annual report for a company, you'll find really all the information on the debt that you need. So I'm going to use a company that I actually spoke about yesterday on the Punch Card Investing YouTube channel, which is Thor Industries. Now Thor Industries does have about $1.6 billion or so in debt. So if you open up their recent annual report, which I think just came out this week, and you just do a quick Control F and search for debt maturities in their annual report, you'll get some really useful information on how that debt is structured. And what I'm really trying to understand here is twofold. So the first thing I'm trying to understand is, does Thor Industries in this example have any big debt payments coming due soon? So typically when a company takes on debt, it's not like a traditional mortgage you might get on a house where you're making payments every fortnight or every month, and each of those payments has an amount in that payment that will cover interest and an amount in that payment that will cover your principal and kind of be reducing the outstanding loan that you have. That's not typically how corporate debt is structured. Generally, and this is the case with Thor Industries, you're just paying kind of interest only on that debt most of the time, and then on a certain date or maybe on a couple of dates, you will basically have a big lump sum payment to repay oftentimes the entire amount of that particular loan. So if we look at that debt maturity profile for Thor Industries, you'll see that they have a few kind of smaller payments due over the next couple of years, but really the bulk of that $1.6 billion in debt that they have outstanding isn't due until 2026. So that's great for me as a long-term investor in Thor. It's going to allow me to understand, are Thor going to be able to meet their obligations for their debt requirements? Now, if this full 1.6 billion was due, next year and Thor doesn't have any cash lying around, that would obviously be a concern. But I can start to understand why Thor has taken on the debt, and then I can start to do some maths on the actual underlying business and how much cash I think that's going to produce between now and 2026, and then I can get a really good feel for whether I think it's reasonable that Thor is going to be able to meet that big debt payment. The other thing that part of the annual report is going to tell me is also the interest rate that Thor are paying on that debt. So there'll often be some commentary above those debt maturities in an annual report that will tell you all the different loans that that particular company has, and you can see what kind of interest rate they're paying on it. So are they paying 3 or 4 or 5%, or do they have some crazy expensive loan where they're paying like 12 or 15%? You can get a real feel for that, and in certain situations it can actually be an opportunity. If you find a company that is paying some really high interest rate on its debt and they've just come through like some sort of turnaround situation or something, there's a good chance often that they can refinance that and get new loans at much lower interest rates, which can really improve the underlying cash flows for that business. And in my view, this is why I really don't like those super simple rules of just don't buy a company with debt, or don't buy a company with more than 2 or 3 years of earnings in long-term debt. It really just doesn't give you a good understanding of what those debt maturity profiles actually look like for a particular business. If a business does have 3 years of earnings and debt, but all that debt's due next year and they have no cash on hand, that's quite a bad situation. But if they have, 5 years worth of earnings and debt, but the debt's not due for 10 years, maybe that's not as bad a situation. So you really need to understand what those maturity profiles look like, and also the interest rates that they're paying on those loans. Now, just like the real estate investment example I talked about earlier, we have this $1 million home and you borrow $800,000 and put $200,000 down, and you can potentially get really high returns on equity. The same thing applies to businesses in the stock market. So just to give you an example of that, there is quite a famous investment that Charlie Munger actually made in the early 2000s in a business called Tenneco. And Tenneco was about a 6 or 7x for Charlie Munger in only maybe 3 years. He had really dramatically good returns and crazy good returns from that particular investment. And one of the reasons that Charlie Munger was able to do that was because of the debt that Tenneco had. Now, anytime you're investing in a business with this level of debt, this is a pretty extreme example, so you really do have to know what you're doing, and you do have to understand the underlying business and so on. There's certainly more risk involved when you get into some of these highly leveraged situations, and the types of situations that have gotten people like Monish Prabrai, for example, in trouble before. He has had a few issues with sort of levered financial institutions in the past, so you do really have to be careful and understand what you're getting into when you look at these types of investments, but it can be very, very powerful on the upside in particular if you're right on the investment. So just to share that example of Tenneco, Tenneco had some really interesting stats if you look at the pricing of that company when Charlie Munger bought in. So the market cap of Tenneco at the time was $80 million. So on that basis, you would really think that this is a very small cap company if you can buy all the shares in the entire business for $80 million. But the enterprise value for Tenneco was about $1.6 billion. So if you don't know what the enterprise value is, basically the enterprise value is just the market cap plus any debt and minus any cash. So it really gives you a feel for if you were to acquire the entire business and pocket any cash and pay off all the debt, what's the real price that you're basically paying for that overall kind of business entity. So in the case of Tenneco, it was about $1.6 billion was the enterprise value, but they had about $1.52 billion in net debt. So it was a huge amount of debt that you were buying into, and you only had like an $80 million equity amount, and that's why this was a very highly leveraged situation. So just to give you some maths on that investment from Charlie Munger, the $80 million market cap, the equity in Tenneco, over the next 2 or 3 years went to $560 million. So 80 to 560 is about a 7x, or an addition of about $480 million in equity. Now that sounds like a massive return and a massive increase in the price that people are paying for Tenneco, and that is true when you look at it on a market cap basis, but when you look at it on an enterprise value basis, it's actually nowhere near as impressive. So to add that same $480 million to the enterprise value, that only takes the enterprise value from about 1.6 billion to say 2 or 2.1 billion. So you've got a fairly modest increase in the enterprise value, but since that situation had so much leverage built in and Tenneco had so much debt, that it really pumped up the returns in the equity that Charlie Munger bought by a massive amount. Now that is a really extreme example with a company that had just a slither of equity left and a lot of debt and quite a high enterprise value still, but it just goes to show the potential upside that can be captured in some of these situations. Now it really is important not to be blinded by that upside potential and to still focus primarily on the downside. The last thing you want to do is lose money in one of these situations, and I personally don't know that I would be comfortable investing in a situation with that much leverage, even if I did really understand the debt maturities and the interest rates. That is getting towards the really extreme end of how much debt a company can handle. But if you're someone like Charlie Munger and you're an absolute beast in the investment world and you understand the business really well and you think they can get through it, these are really interesting potential opportunities. Now the final thing I want to touch on in this video is basically how I think about a company paying down debt and how do I think that that is going to impact me as a shareholder, because again I think this is an under-discussed topic and I think people maybe overcomplicate it a little bit, and in my view it's relatively straightforward. So I just want to walk you through some of the numbers. Let's use Thor Industries again as an example. So if we look at the current market cap for Thor, the market cap as of filming this video is about $7 billion US. Now the enterprise value is a little higher than that. Like we just mentioned, they have about 1.6 billion in debt. They also have a little bit of cash around, so the enterprise value is not the full 1.6 billion higher than the market cap, but nonetheless, market cap of about 7 billion right now, and an enterprise value of about 8.2, 8.3 billion. So how would I analyze the situation where Thor basically choose to pay down that debt and where the gap between the market cap and the enterprise value is going to kind of shrink? So if the company has no debt and just assume they have no cash either, basically the market cap and the enterprise value should basically be the same thing. There are other things that get factored into an enterprise value sometimes with preferred shares and so on, but that is not something that applies in the Thor situation. Now the way I think about this is basically the exact same as I talked about in the real estate example at the start of the video with our $1 billion property, 200 grand in equity, 800 grand in debt. Now if you went and paid off the full $800,000 in debt in that particular situation, your equity would grow from 200,000 to $1 million. It's pretty straightforward maths. You now own $1 million house with no debt, so the equity in that particular arrangement is now $1 million. And I view it the exact same way with debt in a publicly traded company. So the current enterprise value for Thor is about 8.2 or 8.3 billion. So if Thor were to pay off all of their debt, I basically see that as accretive to the equity. So all things being equal, I would see the equity going from about 7 billion to about 8.3 billion. And of course, not all things are always equal, and stock markets are volatile and so on, and we can't sort of bank on that exact change showing up in the stock price. But I really do think about, just like in the real estate situation, if $1 is put towards debt repayment, that is exactly $1 that my equity goes up by. Same thing in a public company. If a public company pays off $1 of debt, I see that as adding $1 of value to the equity, which is exactly what you own when you buy shares in a public company. So that's it from me for this one. That is a bit of a basic kind of beginner, overview of debt in public companies. I do hope it was useful. If you did enjoy the video, definitely hit like and also hit subscribe if you haven't subscribed to the channel already. If you think there's anything major that I might have missed, definitely drop that down in the comments below, or if there's anything that you also pay attention to when it comes to debt, definitely let me know. Always keen to learn more about this stuff personally as well. But like I say, that's it from me for this video, and I will see you in the next one. Cheers.